Well, bond yields have reached their highest levels in decades, and it's been a rough time for the share market. Hi everyone, welcome to the Traders Circle Weekly Market Update. Today is Tuesday, the 22nd of August, and before I get started, you do need to be aware that what I say is general advice only, so you need to consider whether it's appropriate for you. One of the big news stories in the Australian market at the moment is the earnings season. So far we've seen plenty of large cap companies report earnings, and it's been a pretty mixed bag. We've seen some good results from CBA, from CSL and a few others, but there's also been some bad reports, particularly today with underwhelming results from BHP, Woodside and also from Coles. With BHP's report today, it was probably broadly in line with market expectations. I think what disappointed was the dividend. So they dropped their payout ratio way down to about 59%. They're paying 80 US cents in dividends for the final dividend payment, and that was versus about 85 US cents expected by analysts. Overall, though, it wasn't too bad of a result, and it was probably about where most people had seen them reporting. Woodside report as well was perhaps a very slight miss, basically pretty close to expectations, but after running up 10 to 20% in the last few months, you have to deliver a very standout report to keep going, and their report wasn't quite that. And then I think Coles' report was the clear miss today. Coles basically wasn't able to achieve better than inflation growth in revenues or profits, and so where some had been expecting they'd be capitalizing on the inflation crisis and basically profiteering off it, perhaps that wasn't quite the result that was displayed in their report. I know when I go to the grocery store, I'm sort of aghast at some of the prices these days, but it didn't feed into their profits in their report today. So there will still be plenty of reports to come in the next couple of weeks. Definitely make sure you check the reporting calendars if you're considering a trade or investment. And look, overall this season it's ticking along okay, but it hasn't been strong enough or negative enough to influence the overall market movement by itself. Now, what has been strong enough to influence movement has been the movement in yields, government bond yields in particular. Here in Australia, our government bond yields have pushed way up throughout the month of August. We've seen our 10-year reach the key level of about 4.3% yield. This is a pretty key level. It's basically the highest level we've seen since 2013. We got to this level in July, we got to this level in October last year, but each time we sort of stalled and fell back off from here. If our 10-year does go through this level, and if our yield curve does rise through its current levels, these will be the highest government bond yields we've been seeing since 2013 for Australia. These are very, very high levels, and they basically say that the market's not convinced that we've seen peak interest rates. The market's not convinced that the inflation battle is over. And they are suggesting that there are potentially more rate rises to come. Obviously, that's not great. That's not what we want to see, and that's not what the market wants to see. And it's definitely been a big contributing factor to the sell-off that we've seen in August so far, and that is the rise in government bond yields. It's the same story in the US. US markets are also down about 5% for the month of August, and again, it's because of the market pricing in more rate rises potentially, or at least higher for longer interest rates, and that's been reflected in their government bond yields. So US government bond yields are basically at 15-year highs, levels not seen since 2008. And if we look back and we have a think about what happened in 2008, well, it wasn't a great outcome for markets. And so I think a lot of the negativity we've been seeing in our market, in the US market, is being driven by this yield story. And that brings me on to the next point, and that is Jackson Hole. So this week we've got the US Federal Reserve, the US Central Bank. They're meeting at their policy symposium. They do it once a year at Jackson Hole, Wyoming. A very, very dramatically beautiful landscape there. Absolutely stunning spot. But I think they'll be focused on other things at this meeting. So, we've seen the talk about the battle with inflation. We did see US CPI growth pick up a bit in July. We've seen oil prices push up. And everyone's starting to question the narrative from earlier in the year that we were at peak interest rates. So we're expecting the Fed members to come out and speak on Friday and over the weekend and basically talk about how they're going to adjust their approach to markets, how they're going to adjust their approach to monetary policy, and basically indicate whether they see many more rate rises or not. Now, after the extreme volatility we've seen in bond markets with yields rising and in the share market, there are some that are saying that the Fed members will come out and try and soothe people's fears, try and soothe concerns. And if you're a bullish investor, that'd be your best hope for the end of this week. That basically we get Powell come out on Friday and say, yes, we're aware of developments, but we're not going to go too crazy. If there are more rate rises, which there might be, and he's definitely probably going to retain a tightening bias, he will also point to perhaps some of the deflationary pressures. The fact that CPI growth in the US has come way down. The fact that prices are coming down. The fact that borrowing is getting very expensive. So hopefully, if you are a bull and if you have shares or you just want to see the market higher, that's what we'll be hoping for. Some more soothing statements from the Fed members as they finish up their policy meetings towards the end of this week. Alright, so let's have a look at the charts, guys. This is the Australian stock market. This is the top 200 share index, and basically we can see that it's been coming off all of the month of August. Roughly a 5% fall from our close in July to today's levels. Now, a lot of this, like we've said, is the rise in government bond yields, perhaps the market pricing in more interest rate rises, but part of this is also economic weakness in China. So we've seen issues with the Chinese property market, Chinese construction space, but also just weak retail sales over there, weak industrial production, and just a general slowdown in the Chinese economy. Things haven't been helped by the fact that usually we'd see a stimulus response from Chinese authorities in relation to this, but so far they haven't really been too aggressive in doing that. Some people are saying that they're comfortable letting the economy sort of falter a bit and flounder a bit. But I think a more reasonable answer to that question is the fact that in the past their stimulus has been revolved around property and revolved around cutting interest rates. And the issue with that this time around is there are real debt issues in their property market and their construction space. And if they try and stimulate by using that lever, they risk creating those issues all over again or worsening those issues. So instead, I think they're just not too sure how to respond to it. And part of the selling recently, in addition to the rising bond yields, has probably been a bit of fear around the Chinese economy. And if you look at the chart of Rio or BHP or Fortescue or any of the other material stocks, definitely you're seeing some pretty severe selling above and beyond that which has been seen by the rest of the market. So if we look at our chart, yes, we've come off in August. Yes, there might be a potential downtrend starting to form. It won't be confirmed until we get a potential third touch. But there is also a very, very speculative uptrend starting to form, perhaps, from our lows of October last year. If we do see a bullish bar off this sort of roughly 7100 level, that would likely be a confirmation, I should say, of this uptrend line. So we'll be keeping a very close eye on this level, 7100, to see if we can get some buying above this level. And that would be, for me, a sign that we're going to come back to the potential downtrend line here and moving averages at roughly 7200 to 7240. Just before I move on to the US market, it is interesting to note the low of last year here in October. That did coincide with the peak in government bond yields back then. That coincided with the 4.3% on the 10-year, which is right where our 10-year government bond yield is sitting now. So hopefully we see our market bounce up a bit from here and those government bond yields tick back down and a hold of this trend line. But the potential resistance levels aren't too far away. I wouldn't be banking on too much more than 7250 in the short term. For the US market, they've also had a pretty rough August. They've also come off around 5% from their peak. This is the US S&P 500, their most broad-based index, the 500 largest stocks. And we've got a very key support level here at, let's say, 43.20. It was the low back in June, and it's been held in the last few days. Also a bit of a downtrend line forming, and they did bounce off this level overnight, but they're not too far away from the downtrend line now. We do want to be careful about the potential for a huge head and shoulders pattern forming. And the problem with the head and shoulders is if we do break the neckline, which is this 43.30 level, we would expect a very, very large fall below that neckline, probably bringing it back to around the 200-day moving average here at 41.50. So a lot of this will be determined by the Fed members later this week and what they say, and whether there's more rate rises to come, and whether yields continue higher after those statements. Alright guys, that's it for this week. Hopefully you enjoyed. If you did, click the subscribe button, click the like button, and I'll see you in the next one.